Hi everyone, lovely to have you here for this Lunch and Learn session. My name is Alison Bird. I'm a program manager here at Climate Salad, and I'm very grateful to be with you today. I would like to begin by acknowledging the traditional owners of the land on which we meet today, which of course will be different for all of us. For me, that's the Minjungal people of the Bundjalung Nation, and I pay my respects to elders past and present and extend that respect to other Aboriginal and Torres Strait Islander people joining us today. If you haven't already, please share in the chat your name, business, and where you're tuning in from. Always good to know. We've seen a few names there that we recognise, so definitely pop that in the chat. Today's session, From Seed to Scale, how to prepare for a successful Series A raise, is in partnership with our friends at KPMG High Growth Ventures. And there'll certainly be an opportunity for questions. So do pop any that you have in the chat as we go, and we'll make sure that those get answered. Kylie, I'll pass it over to you.
Thanks, Alison. So hi, everybody. I think everyone's probably pretty used to me by now. I've been doing this for a little while. So I'm Kylie Little. I'm with the Climate Tech Lead in the High Growth Ventures team. For anyone that is new, just in case there's someone out there that doesn't know High Growth Ventures, our focus is really on how we can connect founders and their teams into the KPMG services that can really help them grow a sustainable business and scale that business. So we do a lot of different services really designed for startups, from bookkeeping and finance, R&D grants, tax, but also all the way through to sort of financial modelling and really supporting, and very much supporting with a specific climate tech lens. We're learning more and more about those specific needs for climate tech companies. These sessions are really about you guys asking questions. So we've got two fabulous experts here that you get access to today. And what we'll do is we'll just kick off and just start asking a few questions initially, just to get everyone warmed up. But if you've got questions you want to throw in, feel free to put up your hand or throw them in the chat, and we can come over to you and ask those of our two fabulous guests. So the two amazing people we're joined by today are Rachel Yang, partner at Giant Leap, and Josh Geelan, who works really closely with founders. He's a partner at High Growth at KPMG, who works with our founders across the High Growth Ventures team. I thought it might be better to get you guys to do your intros because you know more about yourselves and you'll probably do a better version. So Rachel, I might get you to do an intro first, and then Josh will come back and get you to do your introduction.
Thanks, Kylie. Hi, everyone. Great to be here. Nice to see a few familiar faces on the call as well. So I'm Rachel. I'm a partner at Giant Leap. So Giant Leap is Australia's first 100% impact-focused venture capital fund. So we invest across a range of different areas, so that being climate, health, education, and equality. And really what we look for is that combination of impact and commercial scale. So we're not looking to trade off one for the other. We're really looking for the same returns as traditional venture capital funds and the same growth trajectory, but also looking for that embedded impact, because we feel that we have a lot of pressing problems in the world that need to be solved, and we think founders are the best avenue to help us solve those problems. So we do invest in a range of businesses. We have around 30 in our portfolio to date, a range in the climate space, and some of you may have heard of some of these companies, but we're pretty broad in our definition of climate. So some in the kind of waste management space, carbon accounting, and even brands like Who Gives a Crap, which is a consumer brand that's really looking at tackling sustainability in another way from the consumer angle. So that's me.
Awesome. And Josh?
Thanks, Kylie. Good afternoon, everybody. So my name's Josh. I'm a partner with KPMG. I've got two roles within the firm. One of those roles is acting as an outsourced or a virtual CFO, mostly for high growth venture clients, but also for family offices and high net worth individuals as well, and a couple of government entities. And my role there is on the high growth venture side is mostly with tech and climate tech companies, about taking them through to exit and supporting that growth trajectory. The other side of what I do is I'm the national lead partner for ESG and sustainability, typically with a similar portfolio, but also including venture capital and private equity funds, and also do quite a bit more work with family offices and wealthy families in that space as well. Prior to joining KPMG, I've had a bit of a mixed background with second-tier firms, but I've also been a founder myself with some tech companies both here and in the US 3 times as well, and had, let's call it 2.5 exits. I'll tell you that story another day, but anyway, been through there on the journey and felt the pain and the joy that goes with it as well. So thanks for having us here today.
No worries. So I guess for everyone on the call, I think we're going to throw up a poll and just check where everyone's at in terms of stage of funding. But anyone that has, they've sort of hit their seed round and now they're headed for Series A, which is, I guess, what we're talking about today. I guess you'll all realise that, what you're looking at now is a sort of a very different view of what you need to present in terms of heading into Series A. And Josh and Rachel are probably really well positioned in terms of understanding how to sort of pull that apart a little bit for you and actually drill into what should you be thinking about? What are some of those things you could be considering? So Rachel, I might throw to you first. Given there's probably a lot of confusion, we talked about this yesterday in the market now about, funding stages and what do they look like, and there's now a million pre-series, pre-seed, pre-seed, pre-series A, Series A, and it'd be great to get you to give us a sort of a bit of an understanding of, how would you see seed stage, and then how do you see Series A? Like, what is the definition of those for you?
So it is a bit confusing out there in the market because everyone has their own definition of seed and Series A, and I don't think there is a textbook that we can kind of refer to and say this is seed and this is Series A. But the way I think about it is very much about risk profile for the investors and thinking about their risk tolerance and thinking about at seed, it's much riskier for an investment. And so that's kind of early product, some initial sales, but not having that kind of sales engine built up yet, just kind of working out where your product market fit is, and some just really demonstrating that there is a problem that you're solving, and that your solution is tackling that. When you move to Series A, it's more about getting that sales engine going and really having the repeatable sales, demonstrating that there's been month-on-month growth from your seed stage, and being able to share with investors that there is a trajectory for further growth because you've really nailed that kind of initial sales approach. And so that's kind of how we see things without there being really hard and fast rules around metrics.
Mm-hmm. And Josh, do you have any views of that? I mean, you obviously work with a lot of founders, so you're sort of at coalface with them. But have you seen anything around sort of what you're seeing at that seed and Series A stage in terms of, I guess, what founders understand about what they need to be doing?
Yeah, I guess to Rachel's point, it's really a mixed bag and quite confusing in a lot of senses as well, depending on who you talk to. One way I like to think of that with my clients is that at seed or pre-seed, it's really about you as a founder and about your idea. And investors are basically looking for the best founders with the best idea. When we get to Series A, it's about, well, how do we commercialize that? Where are we now? Where do we want to be? How are we going to exit that? And to Rachel's point, how are we going to chase that sales engine? Where we've seen that change, though, in the last sort of 6 to 9 months in particularly, is really around a shift from growth for the sake of, for growth's sake and at all costs, versus more of a conservative approach around, well, let's actually make sure it's profitable growth. We're not just going to fund growth and market share endlessly. It needs to be strategic, and it needs to, you need to be able to show that capital return and capital efficiency to investors down that pathway as well, and really chase organic growth. But I think Rachel's point is absolutely right. Go past proof of concept and then get out there and grow it.
Okay, and Rachel, so we're going to jump in and have a bit more of a chat about what are some of the specifics that you should be thinking about heading into Series A. But just because we've been in such a a tricky funding environment for some time now, how are you seeing that landscape change for startups and for funding, and how's that evolved in recent years, and particularly in the climate tech sector? Are you seeing that shifting?
So I'll talk more broadly about the market and then dive in a bit about the climate sector. But firstly, in the broader market, we are seeing there has been a downturn. There has been, I guess, a decrease in valuations, or slowdown in investments that are being made. The cadence of investments for a lot of funds and individual investors has really slowed right down. And I think it's people being a bit gun-shy in the sense that they're not sure what's happening in the market. And with this downturn, there's just that lower tolerance for risk. And so I think that's definitely playing out in the startup landscape and the investment landscape. So that's one area to think about for startups. But then in terms of definitions as well, the Series A versus seed, we're seeing a gradual shift to more mature businesses in those definitions as well. And so what you could have gotten away with as seed is potentially even a pre-product And pre-revenue business is really getting towards now more of those early revenues and that maturation of a business before it's kind of defined as a seed or Series A. Then in the climate space specifically, I think we're still seeing a lot of founders coming out and trying to raise in the climate space because these problems aren't going away. They need to be solved. And so I think investors are seeing that as well. So I don't see the slowdown as dramatic in the climate space as it has been in other sectors. But I certainly do see that the broader flow-on effects from the broader market changes flowing into climate tech, but just maybe not as aggressively.
Okay. And Josh, I mean, we obviously work with quite a lot of climate techs in here, but like what are you seeing, I guess, over that sort of last sort of 12 to 18 months as the sort of funding environment's changed? What are your observations of what you're seeing that's sort of shifting for those founders as they're sort of trying to move from that seed to Series A stage? Like what differences are there?
I think we're seeing a lot of family offices step up to the plate as well. So as a firm and myself personally, we do a lot of work with family offices around the country. And last year I met with about 30 or 31 of them and asked them 2 questions. And the first was, well, what's your view about climate tech? And overwhelmingly what they said was their view is climate tech represents one of the greatest, if not the greatest, investment opportunity of a generation. Their greatest challenge, though, which is the second question, is access to the absolute best founders and ideas as early as possible. So on one hand, we have founders who are struggling to raise or, looking to VCs and to family offices to help them raise through, subsequent rounds as well, but can't find the family offices if they want to go down that route. But the family offices actually want access to those people as well. So there's a real disconnect between both of those in terms of how do we bring those together to help some of those deals get across the line. So certainly we've seen a lot of clients pivot towards family office. Giant Leap's not in this bucket, but a lot of the VCs are sort of struggling with climate tech a fair bit and wondering, well, what do we do? How do we actually play in this space? So obviously impact focused VCs are very different to that, that we've definitely seen family offices come through to the mark. Quite a few of ours from Series A plus are also looking at going to the US. And so they're either going there prematurely or early, either to raise capital or to expand growth as well. That's not something I necessarily saw with my clients prior to this, but climate techs are really acknowledging that it's a busy space, it's a noisy space now. We've got to stand out from the crowd, and we want access to market and access to capital to do that. So certainly some interesting trends, but I agree. I think this space is weathering the storm better than most other sectors that we're seeing at the moment.
Okay.
Kylie, if I'll just jump in for a second, there's a question there from Joe, just wondering whether those trends that you're seeing, whether that's specific to Australia or whether that's in the US as well.
So I can jump in here. It's certainly in the US as well, if not more extreme in the US. I think they've been affected more significantly in the startup space than we have been in Australia. So I think actually it's been pretty severe over there with a lot of redundancies and a lot of startups that we've been hearing. And there's still a lot of capital. The ecosystem more broadly of investors is much larger in the US, but in terms of conservatism, for example, Australian startups going over to raise in the US, they've had a much harder time because a lot of the US investors are wanting to really have that US traction before they invest, and US domiciled startups for them to invest in rather than Australian startups. So it's been a lot harder for Australian startups raising in the US as well.
And that's interesting because I think one of the biggest things we're seeing coming through, it certainly came through in the Climate Salad Industry Report, is a huge motivation for Australian founders to get to the US or to go global as early as they can. So it's kind of interesting, like that push, and I mean we'll probably sort of come to this as we go through, but that push at seed stage to be really sort of getting traction, to be trying to sort of get into the US and get some sort of footprint there. And I guess it's interesting, Rachel, to understand your thoughts on that, like, because sometimes, if it's too early, what are your thoughts on that? Or like, what is your view of somebody that's really pushing to get into those global markets at that earlier stage?
I think it's great to be able to have that early traction in global markets to demonstrate that you are a global brand that can scale, because Australia is really too small for a lot of startups to be able to get the scale they need for venture returns. And so I would say as soon as you can get global traction, but it's not to say that the investors overseas will, I guess, be likely to invest straight away as soon as you've got global traction. I think that it's a long journey. So the earlier you can start with that global traction, the better.
Okay, great. And Josh, just a question there in the around family office, like about the sort of the pathways to family office, because I mean, I know that we talk to so many founders here, and so many of them are really, really interested in getting in front of family office, but it's harder. Like, you know, do you have any understanding of the pathways or suggestions on how to do that?
Well, it's a really great question, actually. And just at the outset, sorry, a lot of family offices, you can split them into two buckets. One bucket is quite visible, quite high profile, wants that publicity in a lot of ways. I would say that the majority are very, very private, hard to find, and deliberately so. But what, in my experience, the ones I look after certainly do is monitor the watering holes. So Climate Salad, Innovation Bay, StartMate, LaunchVic, all those watering holes of innovation, you can be almost guaranteed they will be there, they'll be watching. So you need to, and one of the easiest things you can do for those forums that are free or quite affordable, be a part of all of them where you can, be visible, make sure you've seen multiple watering holes. So most of my family office clients will watch those watering holes, and where they see those same clients come through, founders come through, that gives them confidence, and you start building credibility. They will reach out to you. And the most ideal thing you can do, and some of our clients have managed to achieve it, is you want to be the magnet where they go, that founder is amazing, I love what they're doing, I want in. And they'll come to you and have those conversations. That's a complete flip to you chasing them, which is still very valid, of course. So that's probably the easiest thing you can do. But otherwise, they are a bit of a mythical beast if they're very on the private end of the spectrum. So be visible, be there, go to all those networking events. They will be there. Sometimes they'll just be hiding.
Okay, great. And so if we get into like sort of, I guess the nuts and bolts of really sort of going into a Series A round, it'd be good to explore like some of the business functions and the kind of maturity that you would be expected to be displaying as you're heading into that Series A round. So maybe starting with you, Rachel, like, you know, what are some of your thoughts on what you want to see from those companies?
So between seed and Series A, we'd really like to start seeing the founders grow out their team and be able to build a team where they can lead and move into different spaces where they don't have to do everything. So at seed stage, it's usually the founders doing absolutely everything. And then as you're scaling, that's not scalable in itself. And so being able to bring people around you and hire the right people that will get their hands dirty and support you as you scale. I think that's really key, to be able to demonstrate that and to be able to show that you're attracting the right types of talent that can scale with you as you get to Series B, etc. And so you know, there are ways to incentivize your team around ESOP and just having options for them in terms of equity. And then also because at the early stages, you often can't afford to pay them maybe necessarily for what their skills and experience require. And so there's that kind of approach. And so thinking in a clever way about that and really building out the team. And then also seeing that, like I was saying before, the repeatable sales approach and that kind of month-on-month growth. Those are a couple of key areas that I think we'd look to before, you know, going further and progressing into exploring an investment.
Okay. And Josh, I'm going to come back to you on this one, but just one more question for you, Rachel. I've actually heard of founders talking about the fact that, you know, they've sort of gotten to Series A, they've raised at Series A, and then they've been told that they probably hit Series A too early. You know, they got that funding and then they're being seen as kind of not ready for B, but they haven't got enough funding to progress. Like, do you have a view on whether there's a kind of a right time, or is there a way to sort of pick that right time?
That's a really tricky one, I would say, particularly in this environment where it is hard to raise. Ensuring you have enough runway to get you to the next set of milestones, or to at least show the traction you need to get to that Series B, is really key. So we're typically saying, you know, anywhere between 18 plus months, 18 to 24 at least months runway, to ensure that you have that time and capital to be able to invest to show the growth you need for the next stage is really important. And that raising will always take longer than you think. So at the very least, you'd want minimum 6 months, if not kind of 12 months to be able to raise. And so you've got the kind of 12 months raising process, 18 to 24 months runway after that, and just ensuring that those types of timeframes you've planned for when you're raising, because that's people do get stuck, and what they end up doing, which is fine, but it's just pretty challenging at the time, is a bridge round. So you've got your existing investors, you'll go back and ask them for additional money before you go out and maybe do another round of funding to external investors. You might just do a bridge round with internal investors, and that is really dependent on the investors you have on your cap table, whether or not they have the capital to be able to follow on to support you in that bridge round before you get to the next stage. So there are a lot of factors like that that you need to think about when bringing on your investors in the first place.
And then there's just a question there from Joe Glester. How do you not get stuck on the endless loop, Rachel? I assume that's the endless fundraising loop, which is so exhausting for everyone, besides the obvious revenue generation angle.
Yeah, it's a tricky one in terms of how do you not get stuck in the loop. I guess it's just being really targeted in approaching the right investors that where you fit their mandate and you can demonstrate that you'll do what you say you'll do. So early conversations, if they've said too early, but it might be the right fit, then being able to say, can I keep you up to date? And sending a regular investor update to show where you're hitting milestones and you are generating that revenue, so that when you come around to ask them for money, in 12 months' time, it's a much easier conversation. You can say, these are all the things I've done, and this is what I said I'd do, this is what I forecast, and this is where I've gotten to. Those conversations are much easier if you're keeping your investors up to date.
Yeah, great. And Josh, so back to you just on that sort of the business functions maturity sort of lens that you're seeing with the founders that you're working with. What are you seeing there, and how have you seen that shift?
I think there's a real misconception that you've got to be perfect for Series A, and I think that's not the reality. I think it comes down to, well, let's get a plan for growth, for scale. To Rachel's point, let's get the right team on board as well. There's plenty of time to be perfect through Series B and C, and it is that evolution of adjusting your risk profile and that sort of stage appropriate maturity and journey as well. I think the most important thing that you expect to see at that point is to really understand your numbers, what the strategy looks like, and go out there and test that strategy. So where are those customers? What's the strategy for getting in front of them? What does that cost you? And is it working in practice? So you've now got your capital. Is it actually working? Do you need to rethink it? And are those actual costs of growth what you thought they would be? So think about the CAC, the LTV, attrition rates, those sort of things. You probably did all the modeling for the Series A on a bunch of assumptions, and that's fine. But post Series A, make sure you reforecast that around the reality. That could be better or worse, but make sure you understand what it is, because likewise, you're going to have to go to your Series B and then start to mature as well. So always focus on the growth. Don't worry about being perfect at stage A, but do think about going down that journey.
Kylie, is this a natural point to put our polls out? I know that we're curious as to what our community's up to. So there's a couple of questions here. Hopefully you can see that. Of what funding stage are you currently at, whether that's pre-seed, seed, Series A, or beyond Series A, and wondering whether you're actively raising.
Mm-hmm. And unsurprisingly, everyone's actively raising.
You're in the right place.
Yeah, that's really interesting. So we had 73% at seed, 22 at pre-seed. So that's interesting. Great. So Josh, and so guys, coming back to that, the information that, I guess in your lens, what you're preparing for founders to take to investors for Series A, how do you work with those founders? What are you doing with them to help them sort of, I guess, present the most compelling picture that they can?
Yeah, I think what you want to do, regardless of which phase you're at, is project a really clear and concise narrative about who you are, what your business idea is, how it works. So what are those drivers for success, but also what are those sensitivities and what's the exit plan? If you can convey that message really authentically and genuinely based on the best available information that you've got, and even better back it up with revenue as you get more mature on that journey, that equals lower risk and generally higher valuations. Now, that can be hard to achieve, but where it looks like it's confusing, and what we find in climate tech and also deep tech as well, a lot of these ideas are quite novel, quite complex as well. If you go into some of the mainstream VC funds, they might not necessarily understand how this works. That lack of clarity, for want of a better word, can look like risk. And so you need to be really clever at stepping beyond, okay, what are we doing? How do we communicate that in a commercial model sense? And as a climate tech, from impact perspective as well, but demystify that, make it as simple as you possibly can and unpack that. What we are seeing a lot of with climate techs, and obviously with my role as head of ESG as well, is they're leading with impact when they raise. And they sort of say, look, we're saving the world, we have a novel solution and the world needs it, all which is probably true. But they are a little bit maybe quiet on the commercial model, or maybe don't have the commercial model fully understood yet. But you actually need to get those concurrently balanced, or even lead with the commercials. And so sometimes we see people focusing too hard on the commercial model and forgetting about the impact as well. Don't get me wrong, they have to go together. But to create impact, first you have to create profit and prosperity and a pathway, staple the impact to that. So be really clear on, yes, what you're doing and how that will save the world and the impact it creates, but be even more clear and create a really simple narrative around the commercial model, what's driving it, what does good look like, but also what are those sensitivities and how we manage for that. And so it's once you unpack that, as a founder, even if you're not a numbers person, you still have to understand it inside out. So you can't outsource that. You need to understand it. People like us can support you and other advisors can support you, but you're the one who needs to go out there and sell that really clearly and succinctly. And if you can do that well, then I think you've got the best chance of raising.
Right. And Rachel, there's just a question there for you. How do you feel about a company using an intermediary like an investment advisory firm to reach out to discuss potential investment?
I think we find that quite challenging, because really at the early stages, we're investing in the founders. And so we want to meet the founders, understand how they're running their business, what their vision is for the future, why they started the business in the first place. And that demonstrates their commitment to growing the business, and really that they're in it for the long haul. And I think when you see an advisor and you meet an advisor, you don't get any of that. You just hear the story, but not any of the kind of real drive of the founder and understanding of who the founder is and who you're ultimately backing. Particularly at the seed stage, there is really just the founders. And if you're spending money on an advisor and with such little resource, it just raises a couple of red flags for us. So, I think it's a tricky one. I know that founders really want to focus on their business and growing their business, but it is important in the capital raising journey to be present and be really key in those conversations.
Okay, good to know. And obviously that financial model is sort of at the core of, I guess the proposition, I guess as Josh said, as much as we're looking at companies with impact, the companies that are going to potentially change the world and do amazing things, without that commercial model behind them, they can't exist. So in terms of thinking about that financial model, can you give us some insight, Rachel, into what you expect to see? Like, what sort of level of model do you want to see, even at seed versus Series A? Like, what is that sort of evolution that you want to see by the time that companies get into a Series A?
So really, we want to see that the financial model demonstrates what you've talked about in your narrative. So if you're a product-led business, for example, we don't want to see 100 salespeople modeled out in your model. Those assumptions are really key to make sure you understand, okay, starting with the story and my vision for the business, how do I translate that into numbers? And then having and it doesn't need to be complex, just a very simple financial model that helps demonstrate where you see the business going. So even to the point where I often say, even though it sounds a bit too granular to talk about these things, I think it's really important to have your key inputs and assumptions very clear up front, and not hidden away in calculations and formulas. Just really be clear about what your assumptions are, and then model out where you think your business is going. And so there are some templates online. I know Michael Batco at StartMate has one online, and those simple financial models that you can build out mean that, and I think you need to be close to it as the founder as well, mean that you can have support for the narrative that you're telling when you're speaking to investors, and they will dive in due diligence into your financial model.
Great. And Josh, just in terms of, sorry, I was just trying to copy that the StartMate modelling in, but I can't get the link to work, but I can come back and add that in. Josh, what's your thinking on, like, I guess, again, with that lens of working with founders, helping them build a model, what's your thinking there in terms of heading into Series A and how you would sort of help them get that thinking about how do they present, or how do they show those numbers?
I think the first question is, like, why are you here? Like, what are you looking to achieve as a business and as a founder? What drives the business? And exactly as you said, Rachel, like, what are those assumptions and inputs? If you can get that really clear, think about how does this actually work? I would always try and build up from that. I think one of the key things to look out for as well, particularly tech companies that we see, is the support cost. So as you do start onboarding those customers, what we typically see is the attrition rates are much higher than we anticipated, and it actually requires a lot more effort and a lot more loving from the team to actually keep those clients sticky, to maintain that LTV, and therefore make sure that CAC is right. And then likewise, support. So often you can underestimate how much support cost is actually needed, and how you get an economy of scale and efficiency through that function as well. So as sensitivities, I think they're two really good assumptions to call out. Well, what is the approach that we've got here to tackling those two challenges? So we've had a few climate techs go through this process, get through to Series A, B, and even beyond, and sort of hit the wall at that point where those costs just sink them. And if they can't raise quick enough to that point that Mick had in there before, that can be a major problem. So really understanding what drives your business and the plan as a founder is the first thing you need to do. And then the second thing is convey that very, very simply. So whether you use a template, that one from StartMate is really good, and there are other ones out there as well. Just be really clear in understanding what are the drivers. Every business will be different, but in a tech business, it's going to be around how do you acquire clients, the cost of them. Once you've got them, how do you optimize the value that they create? So reduce the attrition rates, extend tenure, cross-sell, optimize that revenue stream from them at the lowest possible cost, but maintaining their satisfaction. So if you think about those assumptions around once they're in maintaining and managing, and then minimalizing exit, they're the simplistic drivers that you want to put into that model. And I think if you can do that in the most simplistic way you possibly can, and then get back to growing your business, then you probably achieve what you want to do there.
Okay, cool. And there's just a question here from Carl. Carl, I don't know if you want to just come off and just ask that question, just so that, just for clarity.
Yeah, sure.
Yeah, great.
Yeah, thanks so much so far. There's a lot of interesting information already to process. Yeah, I think with that question, I was just like thinking, and you were talking a little bit, Rachel, about bridge rounds and stuff like that. And there's things that I guess different investors want to see in that model, perhaps, depending on what their mindset is and what their position is. I think, we've had some feedback in the past about, from venture capital needing to see that venture scale opportunity down the line, but other investors wanting to see, that pathway to profitability, and sometimes they're not quite aligned. And obviously we have our vision and how that fits in. And I guess just because if you've got a profitable business, sometimes you almost don't need the big venture capital if you can just grow it steadily, perhaps, or whatever. And that's sometimes a pushback from venture. So a very circuitous way, Josh, of asking about the shifting mindsets, I guess, from investors, and how that actually, differs a bit in terms of who you're targeting, whether it's venture capital or private equity or, whoever else.
Yeah, and first up, I'd say, I love the whole but model and the business point, what we do, and good to see you again. Yeah. But that's absolutely right. It comes down to your business and what you want to achieve in your business, and there's no right or wrong answer about that. So you don't need to go through that perfect, pre-seed, seed, ABC, IPO, exit roadmap at all. you can. There's nothing wrong with that. But there's also nothing wrong with saying, no, we're here to make profit. We want to create a family business. We want to create a family office off the back of it, or we want to do something else with it. That's all the right answer if that's what the founder's ambition is. And so we've got a really great, a couple of clients, but there's one in particular is around that $10 million revenue mark, generating $1.5, $2 million profit per year already. They have no ambition to go and raise capital. They don't need to. They'll just reinvest their own funds to grow, and they've got a pathway to get to 100 mil. That's perfectly fine for what they want to achieve. Different founders in that same business might say, no, we want to go global and we want to do it next year, in which case they definitely need some VC or some PE money. So it comes down to your business and finding the right partner for that business, and whether it's a VC, private equity, family office, or a combination of those things, but finding the right one that's aligned to your values, your ambition, is the first thing you need to do, because then they'll support that. Well, good one will support your journey as well. So yeah, try and get that piece right. In terms of how does that clash, yes, sometimes it does. And I saw your comment there around, well, are we trying to get 100 times exit multiplier, or are we just trying to double our profit next year, sort of thing? Yes, those conversations can definitely be challenging. I've got clients battling those problems right now, and it's a common problem. But once again, find the right investor who's aligned to what you want to achieve and what they want to achieve, and those problems will generally go away. Still always pros and cons and some polarization, but that's the best thing I can give you.
I think as well, just to add to that, there is an increasing shift towards wanting to see a pathway to profitability because of this current environment. And so you'll perhaps have more conversations with investors around that. But as Josh said, just being true to what you actually want to build as a business is really important, because there are many stories of people taking on VC investment, having shown that hockey stick growth model, and then getting pushed by VCs to get to that model, and them not being aligned to the founders themselves. And so then you're at odds, because often a VC investor, a lead, will take a board seat. And then if you're at odds with people on your board, it's a really challenging journey to be on. So ensuring those expectations are lined up front. And then, I'll give you the example of Who Gives a Crap. They have a solid model, strong unit economics. They donate a proportion of their profits to help with sanitation projects, and they've received, alongside our investment, also investment from mainstream VCs. And so it can align if there is that big vision and that pathway to growth, and that the money that you raise is actually to drive growth. Even though you might have a profitable model, you're just pumping more money in to be able to grow and scale the business to where you want to take it.
And it's probably interesting, Carla, one of the things that we're seeing in this sort of the climate tech sector in terms of funding, is because we talk to so many founders, is it's a much more fragmented landscape in terms of how people want to raise, or what sort of funding they want to raise, or how they want to grow. So we said more bootstrapped companies, which I think is a lot of companies that are really trying to sort of nail who they are and what they do and how does this work before they raise, so they don't want to go too early. We saw more companies that are actually very selective about who they will work with, but it feels like much more so than across a sort of a broader portfolio lens that we would see in high growth ventures. There's a very selective approach to how do I do this and how do I make this a sustainable business. And it's interesting, even to the point of like how those companies build those businesses. It's, Josh, you attest to this, that we've got more and more companies, they want to build a good business. Like they actually want it to work, they want it to last. So it's a good thing.
And not everyone's an exit either.
Yeah.
So if that's you and you're like, I want to build a company for my children and pass it down the line, that happens. They're some of our best family businesses. That's not a failure. That's just a reality about your ambition as well. So don't be afraid or shy. It comes down to what you want to achieve out of this.
So we sort of talked a bit about metrics and finances and all that sort of thing, but let's sort of move on to, I guess, Rachel, the sort of the other piece about, like, I guess, the approach to Series A you know, in terms of the materials you want to present and how you go about sort of finding those investors. It'd be great to get some thoughts from you on what are some of those things that you expect to see, and, you know, like in terms of the way those founders are approaching, or what is the approach to you that is actually the most effective?
Yeah, so in terms of materials, a pitch deck is really all you need to be able to approach an investor. It's what we're seeing, thousands of pitches a year. So last year, I think we saw 1,700 pitch decks come through. And so you don't have a lot of time to spend on each one. We will look at every single one, but it could be even just a minute of flicking through. So if you've got a hefty IM that has a lot of text and a lot of detail, we won't actually be able to read it and you won't get your key messages across. So we actually suggest just a pitch deck, which will save you time and save investors time and get your key messages across. That's the best pathway. And then in terms of materials that you want, it's great to be able to have a data room kind of set up when you're getting into due diligence with investors, where you do have a list of these key items that they expect to see. So at Series A, it's things like employment, customer contracts, Ps, your own, all of those things you can put in the data room. But I think, yeah, just having that pitch deck up front as the initial document is key.
Great. And then there's this random guy that's just come on, Mick Lubinskis. He said, we've had a few companies who have interest from corporate investors who may also be customers. What are your thoughts, you guys, on the pros and cons of corporate investment?
I'll go first if you want. I've actually been in that boat as a founder. This is just my personal experience, not clients of mine who've done similar. It's great in terms of, you know, great, there's a distribution channel, gave me instant revenue. This particular business we had was a digital twin. It made it profitable and quite profitable from day one that they came on board, which is fantastic. What it didn't do was give us a valuation on exit though, because we were so dependent upon that customer that they held the cards. Now we end up selling it back to them, which meant there was still a valuation attached. But my view was that always limited the valuation we could achieve from that business because of that. So what was a blessing, what was quite easy is to sort of shoehorn it with that corporate. It did actually restrict us in the end as well, which is, you know, once again, depends what your ambition for the business is, but be aware of that because it certainly could change that pathway you go down.
Do you have thoughts or experience in that space, Rachel?
Yeah, a couple of things. So firstly, I might actually turn off my video because I'm getting patchy internet. Sorry about that. So the first thing I would say is exclusivity is a term which I would be really careful about in seeking investment from corporate investors, because they may just want your business to stay with them. And so that makes it really difficult for scale. Then in terms of terms themselves, with corporate investors, if they're inexperienced, they might have really unfounder-friendly terms, and you just want to be really careful about that. So ensure that you understand whether or not they're experienced investors and you can negotiate terms that suit you. And if you can, talk to others in their portfolio to see what they're like as investors, like you would with any other investor. But I think with corporate VCs, if you're unsure about the experience they have investing in this space, then it can be problematic for you moving forward.
It's interesting, Josh, I heard a similar story from someone last week who was actually talking about taking on corporate investment, and not only did it shut down the exit pathway, but it actually shut down a number of customer pathways for them, and they had to do quite a bit of work to sort of like navigate their way through that. So it's you do have to take some care, I guess, in thinking about how is that going to work for your business.
Yeah, absolutely. I've seen it happen a bit with decarbonisation software, players around that space as well. We've got a number of our clients who have gone down that pathway. You know, for some it works depending on what they want to achieve. But to Rachel's point, yeah, exclusivity comes with a whole bunch of problems as well. So pros and cons, work through if you're considering it, what it would look like for you and what it means. So it's not always a bad thing, but yeah, generally it does limit your options a bit. Yeah,
great. And so Josh, just going back to that, I guess that thinking about, what you need to be showing heading into Series A. What are anything else that you can add in terms of how you should be presenting at Series A, or what you should be presenting at Series A to investors?
Yeah, so I'm a big fan of not having a full-blown IM. So we get a lot of founders coming to us asking whether we can do that, and also that question before about raising capital for them. So as a firm, we don't raise capital below $50 million, and we refuse to for our founders as well. And for that reason, and the same with the IM, you just don't need it. Yes, we can go and do it for you, and other firms can too, but you just don't need it. I think most investors would rather to see you focus on growing the business and why the business is going to work than spending money on those sort of things, to be perfectly honest. So it comes down to a really succinct pitch deck. I've got some family office clients, quite a heavy investor in this climate tech space as well, and he would say to me, I don't even want a pitch deck. I want to meet you, have a coffee, and you give me one page about what your plan is. I'm buying into you and your idea. I don't need a glossy report to tell me that. So if you're sort of Series A and pre, sometimes that's all you need. You just need the right investor. And to Rachel's point, tell the story, because they are investing in you and your passion and your energy to go the distance as well. If you can sell that to them, they're going to go do the DD later, but you don't need to have this massive glossy document to sell it to them. For some, you will. So the point is, know your audience, know who you're approaching, have those lead-in and warm-up conversations. Don't the first time you go to this person is, hi, I'm such and such, nice to meet you, and by the way, here's my pitch deck. Always lead in, always build a genuine relationship over time. And then generally, I think in my experience with my clients, you will need less collateral at that point in time as well. So it's a cost-effective, time-effective way to do it, because it's based on genuine relationships that you build up.
And I guess the key thing everyone's looking for is, how do they get cut through? Like, to your point, Rachel, you're seeing thousands of decks. It's like, what is the thing? How do you get that cut through? And it sounds like that relationship over time is the key way to do that. But is that easy to do? Like, how easy is it to do that, to get through to investors, to actually be able to build those relationships?
So I think a warm intro is really key to that, because we're always looking for data points to help us understand what the founder is like to work with, who they are, and what their business is like. A warm referral helps with the extra data points, and that initial introduction, then staying in touch and keeping the investor up to date, helps you get that familiarity. So when it comes to raise, that you're in a good position to do so. So, some people will say they don't have the networks in order to get that warm intro. Well, communities like this can help you. So ask people on this call for the introductions and try and get in front of people through someone else, because that always helps get cut through.
Yeah, great. And there's a question, Sophia, with us. Do you want to jump off and ask your question, just so that everyone doesn't get sick of seeing our faces?
Yes, absolutely. Sorry, I'm in a bit of a busy office, so apologies for the background noise. So I'm from EcoGen, and we have both hardware and software. So our hardware solution is basically a generator combining solar, battery and wind. We do have some pre-order negotiations with governments and other commercial entities alike, but our secret sauce or big proportion of our business model is the AI that we're developing. And we're developing this with the university, but as you can imagine, it would take years, or hopefully not too long, but a lot of testing, a lot of rigorous cross-examination with industry, etc. So sometimes I feel as though we're defining the vision, but to go into discussing about customer traction when you're developing AI, I'd just like to get some more context around how we can show customer traction for the AI. Please.
Thanks, Sophia. So I can jump in, and Josh, feel free to add. But I think it is really tough with things like that, and when you're commercializing a product or translating research into a product, it takes time. So I think being able to demonstrate that you've got the right team around you and that you have the right networks in order to be able to, as soon as you get the product ready to go, that you can just hit go and scale from there. Data points to indicate that will help. So there's not really, unfortunately, clear metrics or ways of demonstrating that, but being able to show even communities that will likely, that have indicated support. So if you've got a network that you'll be able to go to market through, and showing that go to market strategy really clearly, I think can help with being able to demonstrate that story. And so it really is about the narrative that you demonstrate of how you're going to get to your big vision in the time where you need to build on research and the AI, the machine learning kind of approach. I think that's a really tough one, but being able to show that as soon as you're ready, you can hit go, that's really a great way to kind of cut through.
Great, thanks, Rachel.
Thank you.
So anything else, guys? Like any other final tips? I mean, any other questions in the audience? Because we're sort of getting close to wrapping up. So jump in if you've got anything else. But I guess just any final tips or advice from Rachel, you and Josh, for the audience.
So if there are no kind of additional questions, I think I would just, really drawing on what we've spoken about, but to basically say that business fundamentals and your foundations for your business are going to be key at any stage, so seed or Series A, and being able to demonstrate that to investors in a time where it is a really challenging market, I think is really important. So being able to look at things like, we haven't touched on this, but things like your burn multiple. So, how much you're burning in order to get new revenue is really important. Are you being efficient with your capital? Is something that investors want to see, and just really ensuring that your foundations are strong so that you can scale and demonstrate that to investors.
Great, thank you. And Josh, anything from you?
I think at Series A, it's really important to remember that investors are still buying you as a founder. So yes, they're investing in the business and the growth and all sort of things, but they're still interested in you. And to quote Paul Hogan's 1986 speech, for anyone's that old, he spoke about the 3 Gs: be gracious, be grateful, and get off. And that's exactly true for founders as well. They still want to invest in you. At some point, they want to see that, yes, we can corporatize this thing, we can get a team around you and get rid of the founder, get an exit for them. That's down the track still. So always remember at Series A and pre, you are important, who you are, your energy, your passion, and also your background and skill set, and your ability to lead and build teams as well, to Rachel's point earlier. So be really proud of that. I know it doesn't necessarily come as a natural thing for some people to boast about themselves and talk themselves up, but that's what you need to do in a very authentic, genuine way. So be proud of what you've achieved and what you're going to do, and shine a light on that.
Great, thank you. So thanks, Josh and Rachel, much appreciated for taking the time today. Anyone on the call that actually wants, to reach out, to talk to Josh or to talk to the team here about how we can help you with those business fundamentals, we're always happy to do that. Just feel free to reach out to me and I can find the right person to connect you with. And in the meantime, I think we have another session coming up next month that we're getting ready to go. We'll be back on the call next month. But thanks again, Rachel. Thank you, Josh. And thanks to the Climate Salad team for pulling all this together.
Thanks, Kylie, Josh and Rachel. And thanks everyone for joining us today. As you head out, there is a really quick survey. It's 2 questions, I think, and it also includes if you want to be in touch with the KPMG team to pop your email in there. As you would all know, feedback is really important to make sure that we're able to provide you with content that's relevant and meaningful to you. So thanks everyone for joining us.